Welcome. I'm Greg Brogger, the CEO of Collective Liquidity. Welcome to the first installment of what we're calling Collective Insights, a series of webinars where we will be bringing our community of executives and founders of leading venture-backed companies information about industry trends and about how to navigate those trends in a way that maximizes their wealth over the long run. Jake Dunn, Managing Director in the Private Wealth at Morgan Stanley, also a founding partner of the Meltzer Dunn Factory Group. Jake has an enormous amount of expertise and experience in helping the employees of late-stage companies create smart financial plans for capitalizing on an upcoming IPO or sale of their companies. So let's jump right into it. Jake, thank you for being with us. And again, we've let everyone know what your expertise is. So why don't you just take it away?
Perfect. Thank you. You can hear me okay, Greg?
We can. You're good to go.
Perfect. All right. Well, I appreciate everyone's time. Hopefully Phil's predictions come to fruition because IPO markets keep us extra busy. But I think it's actually important to be spending time planning before an IPO or transformational liquidity or an M&A event. So that's what I want to talk about today. Just briefly, we have kind of a two-tiered team at Morgan Stanley. So we've got a private wealth management team, and we have a core wealth management team. We joined the firm about 3.5 years ago after spending our entire careers at a competitor firm. It's been a great experience. For those that may not be familiar, Morgan Stanley is very focused on both the private and obviously the public markets, and there's a lot going on in the ecosystem here as it relates to supporting individuals. So whether that's a founder, C-suite, early employee, and or corporates and issuers that are still private. So really proud and happy to call it home. So kind of two topics I want to talk about today. So one, we call it our blind spot checklist. And so this is really relevant for anybody that either has wealth, whether that's paper, whether that's public or liquid, whether you're single, have a family, have kids, whatever it might be. And frankly, some of these things are important whether or not you have wealth, right? The other area that this often is very relevant for people I work with is dealing with aging parents, right, who may not have their trust and estate documents in place. So I'll go through that. These are just kind of like generic best practices that are really important. And then I want to get a little bit more detailed on some of the considerations to be thinking about as your company or issuer is approaching some type of liquidity event. So, one of the issues, and I'm sure a lot of people on the phone appreciate it, is everyone is so myopically focused on their business that it's really hard to think about other things. And then it's really hard to say, well, why am I going to spend time planning around a potential IPO or a liquidity event 5 years down the road? Well, there's a lot of reasons to do it because there can be really significant, most importantly, tax optimization that can be had by early planning. And then, the other thing that's a big concern is just general risk mitigation. We all have insurance for our cars. Nobody would think about driving a car down the street without auto insurance, but do you have umbrella or liability insurance? And if you don't even know what that is, well, why do I need it, right? So we really try and help people that we work with get their foundation in place. And oftentimes these are the blind spots. So we're thinking about, what happens if you get sued? What happens if you get divorced? This becomes particularly more relevant if and when somebody gets married, if and when somebody starts a family, because there's other considerations they're out of your control. So kind of the core building block there are basic trust and estate documents. And this is like the most morbid part of the conversation, but you're really dealing with low likelihood events that have very high impact. So that could be disability, that could be a lack of mental capacity. We all know that we're going to die, but the low likelihood, hopefully, is a premature death, right? So how do you protect yourself, your family, your loved ones in all those situations? And so it will vary state to state, but you're primarily looking at getting wills, oftentimes revocable trust. Those really deal with the disposition and management of your assets in those scenarios that I listed. It's important to have a health proxy so that if you're in a situation where a doctor or medical professional needs to make a permanent or life-changing decision, that a loved one is doing it. Power of attorney is important as well, so that if you're in a situation where you do lack mental capacity, you have a loved or trusted one that's able to handle your financial matters. And then finally, as people start families and have children, adopt children, guardianship provisions are really important. And that's probably the lowest likelihood event, that two parents or a single parent pass away before their kids are 18. But talk about low likelihood, high impact. Anybody that has children on the phone would never want a situation where the state that they reside in is making a decision. So these are the risks that we're dealing with. All right, now to get to some, now that the basic stuff is done, it really goes through a lot of there's a lot of follow-up. So we often meet people that have great law firms that charge tons of fees and put all these documents in place, and we'll ask, hey, do you have your trust and estate documents in place? And the answer is yes. And then I'll say, do you have a revocable trust? And they'll say yes. And I'll say, well, what do you do with the revocable trust? I said, well, I have a soft copy and then it's in my safe. I said, okay, well, you've got a $4,000 piece of paper, right? So you have to retitle your assets into a revocable trust. And that's often something that either trust and estate attorneys don't follow up on, or clients don't follow up on. So we really try and quarterback that whole process. So it's really important to understand how you own your assets and why you own your assets. So that actually means the titling on your account. So if it's John and Jane Smith, it could be John and Jane Smith Revocable Trust, whatever it might be. You also want to make sure that the titling aligns with the estate plan that you've put together. And so that also includes making sure that you update your retirement beneficiaries. So that's important. Oftentimes we'll trust and estate attorneys we work with, and again, it can be state dependent, estate plan dependent, but they'll typically name the surviving spouse as a primary beneficiary, and then a contingent beneficiary being the person, the account owner's revocable trust, so that if their spouse passes away, those assets then flow into their kind of testamentary documents via the revocable trust and are distributed as they had wished. Life insurance is really important as well. And this becomes more important, especially as you have a family. So, life insurance is one of those things that's it's not a science, it's more of an art. We do try to integrate it into financial planning for our clients, meaning we'll look at what someone's expenses are. And then there's kind of three major things that you're looking to cover for. And this is really the prime example of a premature death. You want to leave some amount of funds to provide for your surviving spouse and family to support themselves for some amount of time. So that ties in to the art and science, right? That's the most unscientific explanation, and there's no right and wrong. But people should have some term insurance. It's relatively cheap. It's easy to put in place. The younger you are, the cheaper it is. And a lot of clients will ladder it out. So you're trying to provide for this liquidity that either will be spent down or that the surviving spouse and the family could live off of. A lot of times clients will want to pay off any mortgages or debt. And then also something that's always pretty important for our clients is supporting college and higher education. So those are kind of the three things that we're working for there. We do help our clients review their property and casualty insurance. There's often blind spots there as well. Morgan Stanley has a relationship with a few of the higher end brokers in the space. And I can give an example. I live in New York State, and I switched brokers quite a while ago, and they reviewed everything for us. And this is a perfect example of something I didn't even know. But in New York State has very low what's called uninsured and underinsured limits, which means I'm driving down the road with car insurance. If somebody hits me that either has no insurance or underinsured, it caps out at like 250, 500K. And so in a catastrophic accident, you could be in a situation where you're not at fault and the insurance money runs out pretty quickly. And so you basically, literally, the solve on this is you list your vehicle on your liability or umbrella policy. And then if your auto exhausts, your liability and umbrella picks it up. I mean, that's just like a very simple nugget that, unfortunately, it's not the quality of the insurance company, but particularly if you're dealing with a Geico or State Farm, not to pick on those companies, but it's very transactional, right? You go online, you buy your car insurance, Geico's, online service with 800 number they don't really care if your auto insurance is listed under your umbrella. So on that, what is liability and umbrella? So liability and umbrella kind of kicks into place after other insurance coverage is exhausted. So that could be auto, that could be home. It's relatively cheap. It usually comes in $5 to $10 million increments. And I do think it's something that's important for people to have. And then also on the issuer side, you need to be thinking about board of director coverage, errors and omissions coverage, and this stuff becomes particularly more relevant as you approach any type of capital markets transaction or M&A. So there's a lot to think about there. Finally, the last thing that's important is something called annual exclusion gifts, and then the lifetime gifting exemption. So right now, under current law, anybody can give anybody they want $18,000 a year. You can give it to your kids. You have unlimited marital transfers, so that's not relevant, but you can give anybody you want $18,000 a year. Now, why is that important? So there's a separate kind of lifetime exemption at the federal level, which means that during someone's lifetime, it's currently $13,610,000 per person, and that can be used during your lifetime or at death. And while that seems like a large amount particularly for founders, C-suite, early employees, there's certainly, and we've all seen it where you have an early engineer at a company with a VP title, and we've seen people have, $100 million outcomes. They were just early, and they also optimized their options, which I'll talk about next. And so, it's really hard to think about starting to gift away large sums of money, especially when you have paper wealth, but even starting to chip away via those annual exclusion gifts. The lifetime exemption is a little bit more relevant right now because under current tax law, January 2026, it's slated to reduce to half of its level, and it's kind of use it or lose it. So it is something that's important. Anything that's illiquid, hard to value, private are optimal things to gift. So private company shares are really good things to gift. It does add some complexity. You really can't give stock options. So you really need to have stock. So that kind of loops in another consideration. So if you have all unexercised options, that's another consideration. How do I get the liquidity? How do I get the liquidity do I want to put more money into the company? What are the different ways to source liquidity? So those are kind of the general things on the blind spot that we go through. And we have a checklist. It's on our website. I'm happy to email it out. So now to flip over to kind of the true pre-IPO planning and what's important for people to be thinking about. So number one, you really just have to understand your equity compensation. What is it? How does it work? Do I have RSUs or RSAs? Do I have non-quals? Do I have ISOs, right? How is it taxed? How are there opportunities for optimization? All these, particularly on the options, so non-quals and ISOs, as the 409A value increases, this all becomes like more expensive, right? Either you're triggering more ordinary income or you're triggering AMT, et cetera. So I think the first step is just really understanding what you own, what you have the right to do, and how to try and optimize it. So that's important. There's a concept called QSBS, which I'll just touch on briefly. QSBS is a qualified small business stock. And it's really a matter of whether or not your shares are eligible. The best practices that we get from attorneys in this space is that the issuers should be providing a statement of supporting facts that your shares may be QSBS eligible, but the onus is on the individual shareholder when you have a realized gain to report it. So what is QSBS? So you may have QSBS eligible shares if the company is a C Corp, if you've held the shares for at least 5 years, if you acquired the shares when the company had under $50 million of gross assets, and then you have to be in like an active business. And there's a number of industries that work. There's some that don't work. A lot of the healthcare and tech and the venture-backed companies do work. And what's the benefit of QSBS? At its most simplest level, you can enjoy $10 million of tax-free capital gains. There are ways to stack the exclusion via trust. There's attorneys and CPAs that we work with that will take the position that married filing jointly can be exempt from 20 million. That's a little bit more on the aggressive side. And just to I'm not giving any tax or legal advice. So I'm just discussing things that we've seen people do under the advisement of CPAs and attorneys. But if you've been in a company early and you think you might have QSBS, there's tremendous planning opportunities. It's mostly focused on income tax optimization, but on larger outcomes, there's estate tax planning opportunities as well. And then finally, does your state recognize that? Some states recognize QSBS, some don't. So that can be a really good place to help prospective clients walk through. I talked a little bit about stock options. One of the biggest things with stock options is, do you have the cash to exercise it, right? And so do you want to put more money into the company? Do you want to borrow? Do you want to put your cash in? And then there's also different liquidity options that are in the marketplace, one of which Collective does have, is supporting some transactions in that space. So it's really a matter of kind of understanding it and what the costs are and what the tax implications. And then particularly around incentive stock options, you can trigger AMT. So kind of the starting place is, are you familiar with AMT? Do you know how it gets triggered? But probably more important, is your CPA familiar with AMT, right? What we find often is clients are working with fantastic trust and estate attorneys, fantastic CPAs that are great at their practice, but may not have expertise working with venture-backed employees. And it doesn't mean that they're bad practitioners, but you don't necessarily want a CPA filing their second QSBS tax return for yourself, right? So it's really important that you're able to find these practitioners, and they do exist, that really know how to optimize this, and it's not their first time doing it. One of my favorite things is when we'll meet a client, tech, healthcare, venture-backed company, large paper net worth, and they'll say, all right, well, you're willing to invest your time, help us with the blind spot, help us with optimization. I know the end goal is that you guys would ultimately like to manage some assets. I don't really have any assets to manage, but I've got this old 401k at Vanguard. Would you like it? And we always say yes, because when somebody opens an account, they have to open an account, right? It changes the conversation. I don't care if that client brings over 200k. We're in the business of building relationships and giving advice. And what we see all the time is somebody at a tech-backed company, and then they bring over their IRA rollover, and it's 100% in QQQ. And you're like, guys, your entire life is correlated. I don't even want to buy the S&P 500. Like, let's buy some taxable fixed income in your IRA account, right? So, it's really, it is looking at that risk management and trying to diversify with other ideas with liquid assets. So we see that all the time. One thing to understand, especially if you're exploring liquidity options, lending options, secondary, if you're looking at an option like Collective, does your company allow for shares to transfer, right? And have other employees been able to get the board and C-suite to approve it? So that's something that's important to go through. Talked about the CPA and trust and estate attorneys, really making sure you're surrounding yourself with people that know this well. And then really the fun stuff. I mean, post IPO, post 6-month lockup, there's a lot to do with concentrated stock management. I could tell stories of clients that had really large outcomes in 2000 and 2021 and have really large balance sheets, and some that have very small balance sheets, right? So, I mean, there certainly was a lot of froth in the market towards the end of 21. And so, we're in a seat where we don't, and take this with a grain of salt, we don't really care what the stock ticker is. We're not emotionally connected to the stock, and we're purely viewing it from a concentration risk. And so we're able to help clients make prudent decisions about the diversification, particularly when the stock goes public. There's a lot more that can be done when you're not working at the company. There's still things that can be done when you're working there. 10b5-1 plans are one. You can put limit orders in if you're allowed to sell freely. And then if you're no longer at the company, there's 10 other tools that we have in our toolbox as far as diversification, hedging, and monetization. But we've seen enough clients that have really created generational wealth, and we've seen clients blow up generational wealth. And so part of our job is really trying to help. You've gotten this far. It's okay to keep some skin in the game. If you're still at the company, you're still going to get equity compensation. But there's a certain number for clients where if you have X in the bank and you're spending X a year, and your 2 to 3 goals are X, Y, Z over the next 5 to 10 years, there's a number that de-risks your entire life, right? So if that's 10 million or 15 million or 20 million, if we can work to that, we feel comfortable if we want to keep the concentrated stock, but we want to de-risk clients' lives, right? And so it's really important that people are starting to think about that. 10b5-1 plans are they're a great tool. For those that may not be familiar with it, you're basically allowed to um, put together a trading plan for a certain amount of period of time, certain number of shares, certain price. You can sell long stock. You can put ISOs, non-quals in it, and it allows you to sell over, call it 12 months, and you're able to trade through blackouts and closed windows. And so they're a huge pain in the butt, but they're a great tool. And I think Morgan Stanley handles 50% of the 10b5-1 volume on the streets. So thankfully we've got a lot of support there. Where it gets really funky and clunky is when you start putting in stock options, and then we start going down a rabbit hole, because you can optimize a multi-calendar year 10b5-1 plan with stock options. It's pretty technical, but we're not afraid to roll our sleeves up there. We just need to make sure we have the right CPAs in place. But we had a couple. I got a couple scars from that in 21. And then finally on the corporate side, is your cap table clean? Who's managing it? There's kind of two big providers in the market. Morgan Stanley's one of them. Carter's the other one. One has public market capabilities. One doesn't. Not going to say who's who, but that's something that's important. Have you developed relationships with investment bankers? I think and it ties from Phil's comments. Our investment bankers are willing to have conversations and develop relationships and put the time in. Was that the case in 2021? No, they didn't have the time, right? So I don't think it's ever too early to start having those conversations and developing relationships. And then finally, and this was really based on experience with a variety of companies that we covered that went public in 2000 and 2021. I think where there was particular pain were any of the SPAC transactions, but it was very clear that a lot of the stock admins at these companies either didn't have the enough experience, didn't have enough time, didn't have enough resources, and were just really overwhelmed by the process. So, if anybody on the call is either a CEO, CFO, founder, I think the sooner the better to start trying to get those resources together. I mean, there was one company that we worked with. We had, one of 8 early employees, and we know this stuff well. And they sent out like a 16-page FAQ, and I had like 40 questions on it. I didn't even actually understand some of the things that they were trying to explain. And I literally like our client sent 40 questions back in, and that document went from 16 pages to like 28. So it just, it really creates a poor environment for this poor person that's a stock plan administrator, early employees, and in that case, shares were supposed to be available to be sold on a Friday. They weren't available till a Wednesday, and the stock went down, right? So you have real issues there. So the message there on the corporate side is I don't think it's ever too early to start having those conversations, making sure your cap table's in place. Morgan Stanley does have an IPO readiness team. We have a tender team. That's something that we can help with. And so that's on the corporate side. And then, all these different considerations on the personal side. So let me pause there. I know I went through quite a few things. See if maybe there's any questions.
You did cover some ground, and actually one of the questions is for me, because you were talking about 10b5-1 plans. I always have thought of those as really only available to public company executives. So you need that kind of legal structure in place in order to have a kind of multi-month or multi-quarter or multi-year plan to sell outside of insider trading rules and others. But is there any way to or use for a 10b5-1 in the private market if pre-IPO?
No, I don't think in the private market. And I thought you were actually going to ask another question, which is, can you trade under a 10b5-1 if you're not required to? I think the answer is like logically the answer would be yes. I don't know if you'd want to, because it adds extra complexity, right? It's usually for your reporting officers, section 16, et cetera. But there's other ways to, if somebody knows post lockup that they have a goal of getting to whatever that number is, you can create structures, whether it's just limit orders, you can put, well, limit orders you can put in. Anything a little bit more technical, the companies don't really want you to be hedging or putting collars on or selling calls and buying puts, et cetera. But I'm not familiar with anything on a 10b5-1 on a private company.
I see. Well, so maybe not to focus on the negative, but what is sort of the worst mistake that you see some people make in advance of the IPO? So the poster child for why they should have talked to a financial advisor prior to the IPO.
Yeah. Yeah, we see this all the time, and it's kind of our favorite response, which is, we'll be introduced to a senior executive at a private company, and they'll say, "I'm so glad I met you. So glad you know how to help me here. I completely screwed this up in my last company." And we'll just say, "Let me take a guess. You went into the IPO, you had all stock options, you didn't exercise a single share, you had all ordinary income, and then you had AMT." And they're like, "How'd you know?" Like, I don't know, just a wild guess, right? So, but it's not, it's not as simple. It's we laugh, Greg, but it's like it's not this, it's not simple to execute on these things, right? Trust and estate documents, you hire an attorney, you make a bunch of decisions, you write him a check, you sign them, and then hopefully you do your retitling. You revisit that every 5 to 7 years, right? There's really nothing more to that, at least for the basic stuff. When you get to larger net worths, there's more advanced planning that requires a lot more maintenance and is more complex. But it's not a matter of just, okay, fine, that makes sense. I should be exercising my ISOs. Okay, but I don't have the cash, right? Or how do I measure this? If this company works, it's going to represent 80% of my net worth, and I don't want to take the $500,000 of cash that I have and put more into the company. So where do I go then, right? And then there's AMT considerations, and you do have the ability to exercise a certain amount of ISOs every year without triggering AMT, right? So another one, Greg, is I'm glad I found you. Do you have a CPA that knows this space? Because for 2023, the response from my CPA on April 12th was, "I can't believe you did this. Why did you do this? And you owe a ton more money than I projected." And so most people, for generically speaking, let me rephrase that. Folks that don't have private company stock options don't need a forward-looking tax strategist, right? It's okay. What happened last year? Dividends, interest. Hopefully, you don't have a lot of realized gains. Hopefully, you have tax-sensitive equities, et cetera. Maybe you have a couple private investments and one popped and you forgot to tell your CPA. Okay, great. You owe another 10 or 15 grand. What you don't want is, oh my gosh, you shouldn't have exercised all those ISOs. You exercised 10 too many and push yourself into AMT and you owe more money, right? So, it's almost like you kind of like need somebody that's looking forward, and it's really very distinct and prescriptive calendar year planning, right? Because once that calendar closes, you're done, right? And you can optimize along the way. So I think that's another one where clients are they're just with folks that can't support what they need, unfortunately.
Makes sense. Okay. Well, look, I think we're at time, so I think we'll stop there. But I just want to thank you, Jake, very much for spending time with us. Your expertise is enormously helpful to people in this industry. So, all right, everyone, thank you so much. Appreciate it.